Hello and welcome to the Wake Up Call podcast. Today we're speaking with Dr. Joe Salerno about what a gold standard is, the history of the gold standard in the United States, and common objections to a gold standard. Dr. Salerno is an academic vice president of the Mises Institute, a professor of economics at Pace University, and the John V. Denson Professor of Economics at Auburn University. He is editor of the Quarterly Journal of Austrian Economics and the author of Money, Sound and Unsound. You can follow his work at Mises.org and on Facebook. For more information, see the show notes page for this episode at wakeupcallpodcast.com/gold. Dr. Salerno, welcome to the show.
I'm happy to be here.
Okay, so let's just talk about initially, what has a gold standard been historically?
Well, there are two different types of gold standards. The one that people usually refer to is called the classical gold standard. And that was the standard that really came into its own in the 19th century with most industrialized countries. And under that gold standard, basically, each unit of money, so the British pound, the US dollar, the French franc, were defined as a particular weight of gold. So the dollar was defined roughly as 1/20th of an ounce of gold. So it wasn't equal in price to that. It was defined as 1/20th of an ounce of gold. And the British pound was defined as, just as an example, 1/4 of an ounce of gold. So that when you had the exchange rate between the two, it was 1/5 of a pound of gold. 1/5 of an ounce of gold was the British pound. But in any case, so the exchange rate between dollars and gold was roughly $4.86 to buy one British pound. The reason being that the dollar contained 1/5 the amount of gold that a pound did. So this was the basic setup of the gold standard. That gold was the standard money in that sense. So all banknotes and all government-issued paper at the time, paper notes like dollars and so on, all of those were redeemable in gold. So at the rate in the U.S. of 20 ounces, of $20 per ounce. So if you were to bring a $20 bill to a bank or to a government treasury, you would get in return a full ounce of gold.
Okay, so before we move on to sort of a history of the gold standard in the U.S., can we just back up a little bit and can you explain why gold has been accepted as money over time and how a gold standard even came about?
Yeah, well, all money arose out of the problems with barter. And the problem with barter that is sort of the overriding problem is sometimes called a lack of divisibility of a lack of coordination of wants. And what we mean by that is that people's wants don't coincide, which is to say that, if I want a pair of shoes and and you have a pair of shoes to sell, but I have eggs to trade for the shoes, but you're allergic to eggs, let's say, so you don't want my eggs. So then we're stuck. There's a lack of coincidence of wants. Our wants don't coincide. You have what I want. I want your shoes, but you don't want my eggs. So people that encountered these problems, so the more ingenious ones would then say, well, you know what? I'm going to trade my eggs. I can't find shoes right away, but I'm going to trade my eggs for something that the whole society accepts. Let's say something like wheat that everyone uses. So I would go to a wheat farmer and trade my eggs for the wheat and then use some of the wheat to buy the shoes, use another amount of wheat to buy clothing and whatever else I needed. So eventually, one or a few commodities emerged as what we call the medium of exchange in that society. And in history, those plural is media, but those media of exchange included not only gold and silver, but initially, for example, in Virginia, there was tobacco leaves. In Mexico, corn was used. In Africa, iron hose were used, and so on. But eventually, out of those different media of exchange, there emerged pretty much in all societies that good or those goods that we call the precious metals, so gold and silver, because of the special qualities that they had.
And eventually, over time, the United States developed a gold standard, correct? So why don't we have it anymore?
Well, that's a long it takes a long answer for that, but I can be pretty brief about that. Well, governments don't like gold. Okay, so it was a long process. As I said, we had the classical gold standard, let's say in the U.S. in the 19th century, and we had banks which issued currency and also checking deposits, and that was backed by gold, but it wasn't backed 100% by gold. So they were able to inflate, and that inflation was unpopular, and it led to when the banks were losing gold, as people would turn in their paper money for gold to exchange in foreign countries where the prices were not going up by as much because there wasn't much inflation. So as gold flowed out of the country, the banks were forced to stop printing as much money. And so eventually, most governments saw that it was in their interest to take control of banking. So, for example, in the 1690s, the British king set up a central bank, the Bank of England, gave the bank special privileges, and so that they would print money for the king to fight wars and pay for palaces and pay off his friends and so on. But the problem being that the paper still had to be redeemed in gold, so there was still a restraint on the various states that were controlling central banks. So as time went on, we found that more and more control was exercised over the money supply by the various states that controlled the central banks. And the reason why they did that was to be able to raising taxes to pay for wars and palaces and so on. That's very unpopular. And also borrowing money. Well, you have to pay it back eventually, and that results in an increase in taxes. Or you have to you cause interest rates to rise when you're borrowing so much money as states did. So to make a long story short, the most popular way among states, kings and so on, was to just simply print new money and to pay for their debts, to pay for their increased expenditures and so on. And then eventually there were, as I said, when you inflated money, prices went up, interest rates were pushed down artificially, and we got a misallocation of resources. We got the wrong things being produced. Entrepreneurs were misled by the low interest rates to borrow and build new factories and machines and so on. And eventually, when the inflation stopped, as it had to stop at some point, otherwise it would be a hyperinflation, a runaway inflation. So when the inflation did stop, at that point, interest rates went back up to their normal levels, and there were a lot of bankruptcies. And we began to see in the Western world what was called the business cycle. And that started in the late 1700s in Great Britain. And then throughout the 1800s, various countries were afflicted by business cycles, including the U.S. So at that point, the call went out for more central banking. The U.S. resisted, or at least the citizens of the U.S. resisted. Two central banks, or quasi-central banks, were the first Bank of the United States and the second Bank of the United States. One was destroyed by Thomas Jefferson when he was president. He refused to renew its charter through Congress. And then the other in the 1830s under Andrew Jackson, his so-called war against the bank. He saw the bank as being a despotic instrument of the Eastern financial elites and the Eastern manufacturers who wanted low interest rates, and they wanted to cheap money so that they could invest more and turn higher profits. But all of this increasing inflation, they got the money first, and prices went up for the things that they purchased, but the farmers and others in rural America didn't get this new money right away. And so money was redistributed through inflation from the most of the population to the Eastern elites. And so Jackson saw this, and President Jackson was a populist Jeffersonian, and he got Congress to refuse to renew the charter of the second Bank of the U.S., which came up for renewal in 12 years. So that bank went by the wayside.
Okay. So then moving forward from there, can you give sort of a brief overview of the different forms the gold standard has taken in the United States?
Well, in the U.S., there was always pretty much fractional reserve gold standard, but we can do that because prior to the setting up of the Federal Reserve in 1914, the gold standard was a fractional reserve standard, but it was private banks. We had free banking pretty much for much of that part of the gold standard, meaning that private banks had to hold their own gold reserves. And so they were responsible for paying off their depositors and the currency holders who turned in currency for the gold, so that if any particular bank inflated, what would happen would be that prices would rise in that immediate area, since their clients would have more money and would begin spending that money. And as that happened, as prices rose in that small area, people would start using the currency of that bank to buy products from other areas, so that other banks would get their currency and would turn it in for gold. So the inflation was very, very limited, okay, because you had these individual banks that were competing with one another. So and none of them wanted to hold the currency of a bank that was inflating, so that they would turn in that currency right away, and the inflating bank or the more inflationary bank would lose gold. However, after the Civil War, there was a centralization of banking. Actually, during the Civil War, we got the national banking system under Lincoln, and that further centralized control of the banking system in the hands of Wall Street. Okay, the Wall Street banks, and we began to get more intense inflations and therefore more intense recessions. So we had a number of recessions in the 1870s, 1880s, 1890s. We had a panic. 1907, we had a big recession, and so the bottom line in all this was that the bankers got together and pushed for a complete centralization of banking, okay, in a central bank where they would have a lot of influence, and so thus emerged the Fed. Now, let me mention one other thing. During this period, we're still on the gold standard. So when we went back to the gold standard after the Civil War, we had gone off the gold standard at the beginning of the Civil War and then returned by 1879. So from about 1880 to 1896, prices continually fell every year because the amount of goods and services produced by the free market economy was increasing at a fairly rapid rate. So we had a lot of economic growth during that period. And the money supply was increasing, but by not as much. So what we had was gently falling prices. Prices fell from 2 to 3% on an average between 1880 and 1896. And so you had continual deflation that was beneficial to the population, because with the same dollar, you could buy more and more goods. So that by 1896, a dollar was worth 20% more than it actually was in 1800. So the value of the dollar had increased by 20% or so over those years, which means prices had fallen by that amount.
Could you talk about deflation a bit more? Because a lot of times we're kind of told that deflation is really bad and that we have to make sure that we fight deflation. And why are you painting it in such a good light?
Okay, that's a good question. There's a number of different kinds of inflation, but the inflation that we're talking about that's being painted in a good light is called growth deflation. So that simply occurs whenever there's an increase in supply of goods and the money supply doesn't increase, you'll get prices falling. That is, supplies increase, so prices fall. And we can see this happening in many areas in the last 20 years or so. So we had a huge increase in the amount of high-definition television sets. You know, the original price is $20,000. Now you can get one that has a much higher quality than the original one for $500 or $600. The same thing is true with LASIK eye surgery. When that came out, that was $4,000 per eye. But as the services, as LASIK companies have increased their services, the surgery has fallen, to $300-$400 per eye. And we can look at a lot of high-tech products. Laptop computers are one example of it. Desktop computers. All of these things have fallen by thousands of dollars from when they first came onto the market. And one interesting thing is, even though the prices have fallen, For example, computer that may have cost a laptop may have cost $20,000 in 1980, and by 2000 cost something like $700. There was an increase during that 20 years from 500,000 computers produced and shipped in 1980 to 11 million desktop computers that were shipped. So there was an increase of 22 times, even though prices were falling. The reason being that costs were also falling because of the increase in the improvement in technology and the increase in the capital goods that were invested in that industry and lowering costs.
Okay, now something you mentioned that happened during the classical gold standard was, even though there was still an increase in the money supply, it was at a much slower and smaller rate than what has happened since then. Now, a lot of people might claim that that's a problem, that under a gold standard or some form of sound money system, you would have an inadequate growth of the money supply. So what's wrong with that criticism?
Well, money, like any other commodity, its value is determined by supply and demand. So if there are more goods being produced throughout the country, throughout all different sectors of the economy, all that means is that there's a greater demand for money. There are more people who want to sell goods for money, and that will result in a lower price. Now, the criticism the response by the anti-gold people would be, well, then there's a lower price, and that means that we'll have recession because prices will be lower than they were before, and it won't be as profitable to produce these goods, so we won't have growth. But as I mentioned before, the whole reason why there is an increase in the amount of goods and services produced in society, why we have economic growth, is because of the improvement in technology and the increase in saving and investment that continually lowers costs in the economy. So the profit margins don't change. In fact, they grow. The computer industry has grown tremendously with falling prices because costs have fallen more rapidly. So that's the answer. You have to look at what's happening to costs and prices. In a dynamic capitalist economy, costs are continually being driven down by competition.
So tell us a little bit about how we got taken off the gold standard in the 70s.
Okay, so with the Federal Reserve System now in place in 1914, there was a great inflation that took place to pay for World War I, the U.S. participation in World War I. The inflation continued until 1920. It was stopped, and at that point we had a very deep recession. But it only lasted 10, 11 months. So from the middle of 1920 to the middle of 1921, we had a very deep recession. We had prices falling by 30, 40%, and wages were falling and so on. But the point was that the prices and wages readjusted to the deflation. There was a deflation of the money supply that occurred from 20 to 21. The money supply was reduced. And this was the old classical medicine. This was the old way of curing a recession. You allowed prices to reset to their levels that would reestablish profitability. So within 1 year, the recession was over. Then in 1921, the Fed began they discovered what's called open market operations. That is, that they can print money up simply by buying government bonds. So when the Fed buys government bonds, which it still does today, it pays for those bonds by simply writing a check on itself and paying the bank that's selling the Fed the bond. So that puts new money in the banking system, which then can be lent out. And then when it's lent out, it increases in a multiple fashion the amount of checking deposits in the economy. So this was going on in 1921 through 1929. So from 21 through 1928, we had an increase in the money supply. However, and it was a fairly rapid increase in the money supply. Murray Rothbard has calculated it at 6 or 7% per year. But at the same time, this was the Roaring '20s, so that we had a tremendous improvement in technology. We had electricity being introduced. We had refrigeration. Automobiles now, after World War I, were being mass-produced and were a middle-class item. The radio had been invented. So we had a tremendous flourishing of the economy and a tremendous increase in growth. So prices did not change. Okay, prices would have gone up quite a bit if we didn't have growth in the amount of goods, but prices stayed stable. So most economists said, well, you know what? We've pretty much abolished business cycles. Okay, we kept prices stable, and by keeping prices stable, we stopped any inflation from occurring. So therefore, we will never have another recession. So that was their point. But as the Austrian economists, even back in the 1920s, pointed out, Friedrich Hayek and Ludwig von Mises, they said, well, look, the U.S. Central Bank, the Federal Reserve, is printing money like crazy. And if it didn't, prices would actually be naturally falling as they did in the 1880s and 1890s. This would be the natural outcome of economic growth, is for prices to fall. In order to keep prices from falling, which was the Fed's aim, they wanted to stabilize prices, they had to increase the money supply, which then put tremendous downward pressure on interest rates. So interest rates were artificially lowered. And that falsified the profitability of investment opportunities. So there was a lot more borrowing by businesses and a lot of investment that went bad. So the investments, when the inflation was stopped by the Fed or slowed down in 28 and 29, what we had was the stock market crash, because the falsification of the interest rate, driving it down like that, caused a stock market bubble. It caused a real estate bubble. It caused increases in the price of commodities. The only thing that didn't increase was the rapidly growing amount of consumer goods. Their prices did not increase because of economic growth. So the American and British economists were misled into thinking that we had finally abolished the business cycle, that is, by stabilizing prices. But the Austrians, as the Austrians saw, in fact, they completely disrupted the financial markets and caused what we would today call bubbles, real estate bubbles, stock bubbles, and so on. So it was at that point that we got the Great Depression.
Okay, so let's get back to some objections that anti-gold people raise from time to time. And one of those is that a random shock or a discovery of a new large reserve of gold or some major change in the supply of gold can have some adverse effects and cause major issues in the economy. What's wrong with that claim that anti-gold people put forward?
Well, it is true that we've had some big increases in the supply of gold at various points in our history. The late 1840s into 1850s, in the 1870s, gold was discovered. There were new gold finds in Australia and elsewhere. And then in 1896, there was gold discovered in the Yukon, and there was a new process by which gold from older mines could be more profitably mined. But none of this caused a huge disruption. The worst that would happen is that you get a one-shot increase in the price level. And so between 1896 and 1913, we got a continuous increase in prices as a result of the increase in the amount of gold that was being mined. But what was then thought of as a large inflation was laughably small. It was less than 1% per year. So between 1896 and 1914, the price level rose by 13%, less than 1% per year. So I guess to answer your question, since the stock of gold in the world, which has been mined from primitive times, is durable and doesn't disappear, the mining in any one year as a proportion of the stock of gold is very small. So the new gold that's being found in any given year is very, very small, 0.5%, 1%, whatever it might be. And some of it is used up in non-monetary uses. So even if you have a new discovery of gold, you would not have a massive inflation in any sense.
If the United States went back to some form of gold standard and other countries did not, what would the international monetary system look like?
It's a good question. It would look very much like it does now, in fact, except in the U.S., instead of having the dollar as our monetary unit, we'd have gold as the monetary unit. And what would happen would be that there would be floating exchange rates in the rest of the world, assuming the rest of the world decided not to tie on to the gold standard. You might find some countries then fixing the rate of their currency the exchange rate between their currency and the U.S. dollar, because now the U.S. dollar would be a hard currency. So what you would see happening is that the value of the dollar would begin to rise, because there wouldn't be the inflation in the U.S. would stop cold. So then there'd be an initial problem with this, and people have brought this up. If the U.S. went back to the gold standard, they would have to do so at a particular price. They'd have to pick a particular price. If they picked let's say the price of gold now is about $1,000. If they picked $1,000 as the price, then there wouldn't be much of a problem with the transition. That's the price of gold, and now the dollar is fixed at $1,000, so the exchange rates would pretty much stay the same. However, if we wanted to back up all of our let's say checking deposits and currency by gold, we'd have to pick a higher price. Let's say we picked $2,000 or $3,000. Then the price of gold would suddenly be higher in the U.S. It would be $3,000, let's say, and in the markets of the rest of the world, the price of gold would only be $1,000. And in that case, a lot of gold would come flooding into the U.S. and they would buy up a lot of U.S. products. And so we'd be sending a lot of products out of the country, a lot of goods and services out of the country in exchange for gold. That could be disruptive. So one way of going back to gold is to go back to announce that we're going back, let's say within 6 months, see where the price of gold settles. Let's say it settles at $1,000, and then go back at that rate. And then at that rate, the rest of the world, their currencies would fluctuate in value against the dollar. So if they continue to inflate, basically their currencies would depreciate. As I said, I suspect that some countries would want to fix their exchange rate with the dollar, because now the dollar would be as good as gold, and that would stop their currencies from depreciating.
So what do you think the role of gold is going to be in the international monetary system moving forward?
Well, let me only say two things about that. First of all, there is a lot of there used to be a lot of support for having just fluctuating exchange rates, and Milton Friedman and the monetarists were the group that really supported this. And they said, look, if every central bank acted responsibly and increased their money supply at a very slow and steady rate, then what you would have is you would have international order. The exchange rates wouldn't change that much. You wouldn't have a lot of depreciation. But that hasn't been the case. Okay, governments inflate at different rates, and so we have very volatile exchange rates. We have capital flowing into some countries. Let's say emerging market economies when they're doing well, and then flowing out again when they can't pay their debts. So just in the last 5 or 6 years, there's a talk now that we need international monetary coordination, meaning that governments should get together and not exactly fix their exchange rates, but try to get their inflation rates in line, and maybe have some way of communicating about how they're going to change their exchange rates and what kinds of monetary policies they're going to follow. So I see that as a recognition that having a world of competing national fiat currencies whose exchange rates are fluctuating, that's not working. I see even mainstream economists recognizing that. So this new call for international monetary coordination, it's a small step in the direction of people realizing that we need a one world money. Now, whether that's going to happen is another question. I don't think that's going to happen. I don't think that the world as a whole, or even the major countries, will go back to a gold standard, at least not yet. So the next best procedure or proposal for doing that is for the U.S. to unilaterally move back to a gold standard. And I think Representative Ron Paul has come up with a good plan on that. I mean, this was based on plans by other free market economists, such as Hans Sennholz. And that is, look, let's have competition in currency. Let's allow people to use gold and silver if they wish to make exchanges. And the way you do that is by taking off all taxes, sales taxes, capital gains taxes, excise taxes on gold and silver, so it could compete on equal footing with the U.S. dollar, and also allow banks to accept gold deposits and to set up checking accounts for people in terms of gold and silver, and also finally to allow Americans to hold deposits in the form of foreign currencies, euros or yen or pounds. Okay, so then you would have competition among Americans using different currencies, and that would put a brake on how inflationary the Fed could be. Okay, because the dollar would then start to become less acceptable if people had these alternatives. So I think in that situation, gold and silver would win out as the money of the medium of exchange, but that might take a while. But I really am skeptical of the world going back, and I'm also skeptical of having the Federal Reserve System forcing them through Congress to reestablish a gold standard. I think they would undermine it. I don't think we would get the gold standard that we want.
Okay. Well, thank you very much for coming on the show. And is there anywhere else where our listeners can find more of your work?
Yeah, almost all of my work, as I said, is on, or as you said, is on Mises.org. My book and I have hundreds of articles that are up on Mises.org. So just searching on Mises.org is the way to go.
And what do you recommend someone read if they're new to these sorts of ideas?
I recommend very strongly Murray Rothbard's little pamphlet, What Has Government Done to Our Money? And also an article that he wrote in 1962, The Case for a 100% Gold Standard. There's also a little book by Hans Sennholz, who was a student of Ludwig von Mises, called Money and Freedom.
All right, very good. Well, we will link to all of those, and the place to find those links is going to be wakeupcallpodcast.com/gold. And we'll also link to Mises.org from there. For those who are unfamiliar with that website and with the Mises Institute, that is MISES.org. And again, wakeupcallpodcast.com/gold is going to be the place to find links to all of these resources. So on that note, Dr. Salerno, thank you for joining us today and for helping us discuss the gold standard.
Thank you. It was my pleasure.
Thank you very much. Thank you for listening to this episode of the Wake Up Call podcast.
If you would like to listen to more episodes, please subscribe, rate, and review the show on iTunes or subscribe on Stitcher. And check out our website at wakeupcallpodcast.com.
There you will find show notes pages and comment sections dedicated to the show. You can also email us at contact@wakeupcallpodcast.com if you're interested in being interviewed for the show or have any other suggestions.
Thank you.